I'd forget my head if it wasn't screwed on straight. Well, let's. Okay, so now we got the banner up there that says we're recording. Okay, so again, going back to what I was saying before I turned the recording on, um, when we think of budgets, a lot of folks think of our family budget or our personal budget, where we think, how much money do we make? How much do we have to put on the gas, for gas and for car payment and for insurance and all of those kinds of things. And those things are really, a lot of times they're spelled out for us. And it's just a matter if we have to budget for them and make sure we have enough money to cover those expenses. Where when we start talking about business and budgeting and master plans, we have to consider the fact that there's a whole lot more that we have to budget. Okay, we have to figure out how much are we going to produce. Well, in order to know how much we're going to produce, and once we know how much we need to produce, then we have to know how much material we've got to buy and all of these types of things. So one of the first things that we start to look at is a master plan. And let's see if I can make these slides move. So in our first learning objective today, we're going to learn why managers use budgets anyway. Budgets control, how we do our business. We develop a strategy, we set a plan in place, we take action, we have controls in place. Now, this wheel should look very familiar to most of you because I'm sure you've seen it in other classes, just with some different terms in it, but it's still the same basic thing. This is our basic problem-solving model, okay? Where we develop a strategy at the top, you could take that out and identify a problem. And then where plan is, you could take plan out and you could put in there, assess the situation and find the root cause of the problem. Where you've got act down there, you could put develop courses of action and decide which one you're going to operate on. And where you've got controls, that's feedback. Check and see, did the actions you took solve the problem? Well, budgeting is nothing more than a problem-solving model. It's just we use different terms for it, and instead of a problem like most of us think of when we think of problem, when you talk about budgeting, the problem that you're trying to solve is how much of this, and whatever this is, because you may be talking about labor, you may be talking about materials, you may be talking about a lot of different things, but how much of this do I need? Well, in order to know how much of this you need, you've got to go through that same problem-solving model. So the benefits of budgeting, it forces managers to plan. How many of you guys go into a project and you just jump in 2 feet first and you don't make a plan and you kind of figure it out as you go? I should put 2 hands up because that's usually the way I do it. Okay? But when I say that, that's usually when I'm like doing a project at home. Right now there's a project I want to do out in my garage where I want to build myself a workbench. I know myself well enough to know that I want to just jump in and start building it. But I also know that if I do that, I'm going to end up making mistakes along the way. So I have learned that it's far better to actually plan this thing out, draw it out, know how much lumber I need, because I don't want to have to make 5 trips to Lowe's to go get more lumber. Okay? So it forces us to plan, okay? And it also promotes coordination and communication both within our organization, but also with our suppliers and a lot of times with our customers. I go back to that machine shop that I talk about a lot down in Houston. And I had to know not only what my customers needed today, but I had to be able, in order to budget, I had to be able to project what my customers were going to need tomorrow and next week and next month and next year so that I could properly plan. Well, that forces me to communicate with them in order to make sure that I'm planning correctly. And then when we have a budget, it provides us benchmarks to measure ourselves against. Are we where we thought we were going to be? If we make a plan for the next quarter, the next 3 months, well, we might have a couple of benchmarks at the 1 month and 2 month mark so that we can measure ourselves to see, are we where we thought we were going to be? because sometimes we will be farther ahead of where we thought we were going to be, and then now we're going to need to order more material because we're moving faster in our production than we thought. Or maybe we're not moving as fast in production as we thought we would, so now maybe we need to talk to one of our suppliers and have them slow down a shipment because we're not going to need it as soon as we thought. So it gives us different benchmarks that we can measure ourselves against. And that's pretty much it for learning objective 1. Just why do we use budgets to begin with? Okay. So under learning objective 2, we're going to start picking out the basic components of the master budget. Now, those components basically are budgets themselves, but each one of them has their own specific piece to play. So set a budgeted financial statement to support your schedule. There's 3 types of master budgets. Okay, we've got an operating budget, we've got a capital expenditure budget, and we have a financial budget. Those are our master budgets, or those are the components that make up the master budget. I'm sorry. So we have, what are we going to need? What are the budgeting constraints or issues that we have in our operations? And then what are our capital expenditures? Where's our capital? When you hear the term capital expenditures, that's talking about investment. Okay, so we've had folks that have invested in our company, capital expenditures. Let's say, a capital expenditure for Calvary right now, they would love to have a capital campaign where they're raising money and a capital expenditure to be able to build a new building. Because I know right now they'd like to build a new building and tear Philly Hall down. Because that place is a dive. I know, I used to manage that place. It's a dive. Okay, and then the financial one is where are we at? Where are we with our cash flow? Where are we with our the money in the bank, so that we have our operating budget buffers, so we've got money to operate with. Primarily in this class, we're going to concentrate and focus on the operations budget, because as managers, that's usually what we're more concerned with. The capital stuff, where are we spending the capital expenditures to grow and invest? That's usually done by ownership, or if it's not owned as in a single person owning it, it's done by a board of directors. Those types of folks make the capital decisions. And then usually the financial stuff is stuff that's managed either internally with an internal accountant, or externally if we use a CPA or somebody outside of our company. So inside our operating budget, now you guys pay attention. This slide is going to be very useful when you're doing your homework, because it's one of those that steps you through step by step. Okay. So in our operating budget, the first thing we have to know in any operating budget is, what is our sales budget? What do we expect to sell during a given time period? If we're working on a year's budget, we need to know how much we expect to sell during that year. If we're working on a quarterly budget, we need to know how much we expect to sell during that quarter, because everything is going to be based off of how much we expect to sell. Does that make sense? I mean, if we don't know how much we're going to sell, we have no clue how much we need to make, right? So once we've figured out what our sales budget is, the next thing we have to do is figure out our production budget. Our production budget is that, what do we have to produce in order to have the materials on hand to be able to sell what we need to sell for in order to make those sales. Well, one of the things we have to take into consideration in our production budget is how much did we have left over. So let's say we're talking about a budget for this month. Well, if I know I need to make 125,000 pieces of widget A, but I've got 25,000 pieces of widget A left over from last month, then I only need to make 100,000 pieces this month, right? Except that sometimes we take into consideration what we expect to sell next month so that we have some left over. The reason why we had 25,000 left over this month is because last month we intentionally made extra so that we would have some to carry over into this month. And it has a rotating situation, and it's all based on our sales. Well, if we know what our budget is, our production is, we know what our finished goods is, so it's our what we need to make minus our finished goods is excuse me, what we need to have done minus our finished goods is how much we need to make. So if we know how much we need to make, now we can budget how much direct materials do we need to get. How much labor is it going to cost us to get that done? What are our overhead manufacturing costs going to be for that period of time to make however many pieces we've budgeted to make? All of those are going to come together. This one pops in. I don't know why this one pops in when it does. One of the things we have to take into consideration in our calculations is our sales expenses. That's not really a part of our production budget, so that's the reason you see it's over here on the side. Okay, but when we've got our sales in our sales budget, now we can say, okay, our budgeted income statement. So all of this has been working towards a budgeted income statement. We know what our sales is, or we know what our sales is projected to be. So then we can get our production budget. Our production budget is affected by how much did we have left over from last month. Once we have our production budget, then we can determine how much direct materials, how much labor, how much manufacturing overhead. And all that's coming down to our budgeted income statement. But, you know, based on our sales, sometimes we have commissions and other expenses that we have to pay out. So that all has to be calculated in too. So that's the reason you see this is on a separate line, but that becomes part of that budgeted income statement. You guys following with me to this point?
Yes.
Okay. And if you guys, I started doing this, I need to go back and do it on some of my earlier slides, but if you guys look, see this number up here in the top corner?
Yeah.
Point that out to you. If you look on page 300 in the book, it's the same as that sales chart right there.
Oh, okay.
Okay, so I don't have that on every slide, but sometimes you'll see this number up here in the top right hand corner, and that tells you what page to go to the book to find that same chart. Okay, so now we have our budgeted income statement. I'm just going to carry that forward. So now we're talking about capital expenditures and financial budgets. Well, once we have our budgeted income statement, our income meaning our sales minus our cost of goods gives us our operating income. Okay, so we've got our budgeted operating income statement. Well, from there, we can say, now what capital expenditures do we have? So if we've got, this is our budgeted income, and we've got capital expenditures coming out, that's then going to give us our cash flow. But you notice I've got this arrow coming down here and coming over here, because sometimes you're going to have capital expenditures and sometimes you're not. Well, if you don't have capital expenditures, that's just going to flow straight down. If you've got capital expenditures, it's going to flow over and it's going to hit the capital expenditures, because the capital expenditures, how much money you lay out to build a building or to buy a new machine, it's all going to affect how much you have in cash flow. That ultimately ends up giving you your budgeted balance sheet. Okay, that budgeted balance sheet is when it's all said and done, what's our balance at the end? What's our profit and loss? And now understand, when you're talking budgets, these are all, and I hesitate to use the term theoretical, because it's not theory, it's not theoretical. We have solid information to base this on, but this is all projections. at some point you have to go back and compare your projections to what your actual expenses are so that you can come up with an idea of where you're actually meeting or exceeding your goals, or did you fall short of your goals? All of that together is your financial budget. Notice I've got capital expenditures out here. It doesn't fall into this. Capital expenditures a lot of times is its own separate budget, but capital expenditures obviously is going to flow into your cash budget. It's going to affect your cash budget. Now, are you guys tracking with that? Does that make sense? That, I mean, you guys are business majors, so that the basic flow of that shouldn't be anything new to you. You've maybe not seen it laid out in that style or that presentation before, but the methodology shouldn't be new to you. Okay? So now let's start talking about some of this. Sales budget, that was the very first budget at the top of it. So we have to forecast our sales revenues, and it is the cornerstone or the first piece of our budgeting process. Because without our sales budget, we can't do any of the rest of it, because there's no sense in determining how much we need to produce if we don't know how much we're going to sell. Okay? Now, if you're a brand new business, sometimes your projections are going to be way off. But trust me, when I was running my machine shop, that company had been in business for a long time. So when I first got there, it was pretty much steady state. We knew exactly what we were going to be making. Now, the owner, when I got there, was in the process of trying to grow the business. So we were out looking for new customers all the time. And as we found new customers, that affected our sales budget, which in turn affected our production budget and our cash flow budget. So we had to take all of that into consideration. Okay? But once we've got our budgeted target sales, we know what our budgeted target sales is. If we just take our sales times, and let's say we're selling widget A, okay? If we sell widget A for $100 and we're selling 100 of them, then our sales is going to be $1,000. Pretty straightforward, right? Total budgeted sales is the price that you're selling something for times how many of them did you sell. Okay, our production budget is based off of our sales budget. So our production budget is going to be our beginning inventory. How much do we have from our beginning inventory? How much are we producing? Minus how much do we expect to have left over at the end of the period to get our budget sales. Okay, or the way I like to look at it is production. How much do I need to produce? Well, to get my how much I need to produce, if I look at how much I expect to sell plus how much I need left over at the end of the period minus how much I started with, that tells me how much I need to produce. So you guys notice all the same elements are there, and it's just a matter of what are you using as the right side of your equal sign. Okay, if the right side of your equal sign is your budgeted sales, then you're going to take your beginning inventory plus how much you produce minus how much is left over to get your budgeted sales. It's kind of that, kind of almost like the break-even point that we worked on a couple of weeks ago. But as a manager running a plant, as a production manager, I'm not worried so much about my budgeted sales in that I'm not trying to balance to it. What I'm really trying to balance to is how much do I need to produce this month? So if I look at the production equals how much am I supposed to sell plus how much did I have left over for last month minus how much did I have, excuse me, I knew that didn't sound right, so I had to go back. How much do I need to sell minus how much do I need plus, I can't talk today. Let me put numbers to it so I can make myself make sense. So if I know that I've got to sell 100 of my widgets, but I know I want to have 25 of my widgets left over to start next month with. Well, then I'm saying I need to sell 100, plus I need to have 25 left over from in order to start next month. So that at this point now I need to produce 125, right? But let's say I had 35 widgets left over from last month. Well, if I need to sell 100, but I want 25 left over for this month, that means I need 125. But I had 35 left over from last month. That means I really only have to produce 95 in order to meet my production budget for the month. Does that make sense? So it's how much I need to sell, plus what I have left, what I need left over to start next month with, minus what I had left over to start this month with. You guys are so talkative. I never know for sure if I'm getting through to you.
We're just absorbing it all.
Yeah. Okay. So let's open the book and go to exercise 7-10. Now we're going into cash flow part. We're moving out of production and going into cash flow stuff now. Okay. So, but in the book on page 304. Oh, hang on.
325.
That's the 325. Now here's a question I have for you guys. Have you guys ever read these chapters before you come to class, or you just wait for me to explain them to you? Tell me the truth.
I just wait for you to explain it.
Somehow I figured that.
I'm in short
Okay.
fiction, so I have to read a lot. You know?
So if you look, we're skipping from 300 and 304 up to 325. We're going to the back of the book. This is the stuff that's in the next few pages in that chapter, okay? And we're going to talk about budgeted sales. How do we get our budgeted sales? Okay? So we're going to talk about how much sales do we have, and whether we're collecting our cash up front when they deliver it, when we sell something, or whether we're selling stuff on credit. Okay, because in business, quite often, we sell stuff to people, but they don't always pay for it all as they're walking out the door. Okay? So, let's look at a sales budget for this quarter. The quarter ended, okay? So, in March the 31st, we sold a total of $100,000. 30% of that was in cash, meaning as people came in and picked up the parts, they paid us cash for $30,000. But $70,000 of that went to credit. Okay, you can look at the same thing in June and the same thing in September. So these are quarterly endings, March, June, and September. 3-month periods for each one. Okay? Our ending inventory is 10% of the sales for the following quarter. Okay? So we're looking at our sales for the quarter. So the sales for the quarter for March was 100,000. The sales for June was 150,000. The sales for March was 130,000. Okay, our quarterly expected sales is 200,000 for fourth quarter. Our inventory, this is the story problem that goes with 7-10. Okay, 7-10 is at the bottom of 325. So this slide here, we're really not calculating anything on this slide. This slide just is the information from the story problem. If you look at that chart there, that's what it lays out. Okay?
Mm-hmm.
You guys following that with me so far?
I think so.
All right, so we're going to continue on So we're going to bring some of that same information forward into this next chart. Okay. So our budgeted sale in March. Now, we're in the story problem, it tells us here that we're selling these rims. This is a company that sells rims for cars. Okay. It tells us that we sell them our rims for $100 per rim. Okay. So we've gone from our sales budget now to our production budget. If we know that we sell our rims for $100 per rim and we sold $100,000, how many rims does that tell us we're selling? Somebody? Anybody?
1,000?
There you go. So we've got 1,000. Okay. The same thing for June. We've got 150,000 in sales, so we've got 1,500. And in September, we've got 130,000. So the book tells us that our expected sales for quarter 200 or for the fourth quarter is 200,000. So if we continued this out and had another column out here, how much would our expected sales be for the fourth quarter? How many rims would we need to produce for the fourth quarter?
If it's up 10%.
You broke up on me. Say it again.
You go up 10%, right?
Well, it's not necessarily going up 10%. How did we get the 1,000 here? We need to make 1,000 rims for the quarter that ends on 31st of March. How did we get that?
Yeah, the total sales.
Total sales divided by $100 per rim, right?
Yes.
To give us how many. So if we have 200,000 in sales and we're still selling them for $100 a rim, how many rims do we need to produce in the fourth quarter? Come on, you guys, it's the same process.
Is it 1,900?
Well, no, wouldn't it be the 200,000 divided by $100 per rim? So we would need to produce, so for the fourth quarter, we would need to produce 2,000 rims, right?
Yes.
Okay.
Yeah.
So if we know then for the fourth quarter, we got to produce 2,000 rims, just kind of keep that in mind because that's going to come into play here in a minute. Okay. In our story problem, they also tell us, they give us a whole bunch of different prices down here. Okay. Not worried about those prices as much right now because right now we're just worried about production. Okay.
Okay.
So if you turn the page and read some more at the top of the next page, one of the things that it tells you up there is that they decide that they want 10%. They want to have at least 10% of the next quarter sales as ending inventory. Okay, and that's what this number is here, the 10% next quarter sales. So if we know we've got to produce 1,000, but we already know that we're projecting 1,500 as how many we got to produce for next month. 10% of that comes down here as next month's. Okay, so now we know we're going to sell 1,000. We know we need to have an extra 150 left over, so that tells us that we have to make a 1,150 in our production. Okay. Well, this first quarter was January, February, March, and the book tells us that our beginning inventory in 1 January was 100 rims. So if we're going to sell 1,000 rims during this quarter, and we know we need to have 150 rims left over in order to start next quarter with, we got to have our budgeted finished goods available. How much do we have to have available is 1,150. But they also tell us that we have 100 left over from last month. So we only need to make 1,050. So if you guys look at this, say again.
Nothing.
Okay. So if you guys look at this, this is that chart that I showed you back here, right here. This is another way of looking at this same chart right here, okay? Our production, how much do we need, equals what our budgeted sales is, plus what we need to have as an ending inventory, minus what we need, what we started with as a beginning inventory. Our sales plus our ending inventory minus our beginning inventory. This is what we actually physically need to produce. This is what we're going to sell. This is what we need to have left over at the end of the inventory. But this is what we started with. So this is how many we need to physically produce this during this quarter. Okay. Now, if you look though, what was our ending inventory for this quarter automatically moves down and becomes the beginning inventory for next quarter. That's how we get that information. This is what we budgeted to end with in this quarter. Well, if we're ending with it on the 31st of March, then on 1 April, that's the beginning inventory for the next quarter. Okay? A lot of folks get confused with this part right here. Well, if this is what I ended with on this day, the next day, that's what I started with. Pretty straightforward, right? Okay, so let's look at this quarter. Where did we get the 1,500? Oh, and where'd that 1,500 come from?
Wait. 1,500 on June 30th?
Yeah, that for June 30th, for that quarter that ends on June 30. Where did we get that 1,500 from?
So the 1,500 means you take March 150 sales, bring it down, and then multiply that by the number of sales per room. So that's 1,500.
You got the right thing, but you said the wrong words. You take the 150,000 in sales divided by the $100 per rim to get the 1,500. Not multiply.
Where did the 150,000 come from?
The 150,000 is right here.
Oh, right.
150,000 in sales.
Oh, yeah, I see that.
Divided by the $100 per rim tells us we need to make 1,500 rims this quarter.
Right. Okay. Sorry.
Okay. Well, we also need to have 130 rims left over to start the next quarter because it says we want 10% of the next quarter's sales. So if we know we got to make 1,300 the next one, we need 130 left over to start.
Okay.
Okay.
Yeah.
So we add those two together, and that gives us this is our budgeted finished goods available. This is how many finished goods we have to have available. But remember, we had 150 from last quarter. So if we need this many total, well, if we subtract the 150 that we already have on hand, that gets us to 1,480. Make sense? Okay. So Michaela, where did this 1,300 come from?
I have no idea.
Okay. It's the same as what we just went through in June. If we look at the 130,000 in sales, divided by the $100 per rim, that gives us the 1,300 that we have to produce. Okay. Where did this 200 come from?
You took 10% of the 1,300.
No, that 10% of the 1,300 is what we had to do last time.
Oh.
Where did the 200 come from?
I honestly.
I don't know.
That's total. It was from our book, right?
Yeah.
So we did 10% of the following. The
The top-
200,000 divided by $100 per tire And we got our answer, took 10% of that, and then 200.
Right. So at the top of page 326, it tells us that we expected to sell 200,000 in quarter 4.
Yeah.
So that's where the 200 came from. So if we've got the 1,300 that we need, that we're going to sell this month, plus the 200 that we need to have left over so that we can start next quarter with, that gives us a total of 1,500. But remember, we started this quarter with 130 that we had left over from last quarter. So we actually only need to produce 1,370. You guys see how that chart flows? This number right here is a product of what we expect to do the next quarter. But we have to calculate that into what we're going to produce. If we know we're going to sell 1,000 rims this month, we need 150 rims, or excuse me, this quarter. But we need 150 rims left over to start next quarter. Now, why would we need 150 rims left over to start next quarter? What do you think? Why do you think we would need 150 rims left over?
So that way, if someone comes in while you're still making, like in production, then you can still sell.
Exactly. Because chances are we're not going to be able to make 150 rims on the first day of the next quarter, right? So if we've got 150 rims left over, that way if somebody comes in that first week and buys, 20 rims, we've got rims on the shelf that we can sell them right now while we're in the process of making the rims for that next quarter. Okay? So, but if we know we're going to sell 1,000, we got to have 150 left over to start next quarter with. That means totally we need 1,150 rims. But if we started with 100 rims left over from last quarter, then we actually only need to make 1,050.
Would this production still be just in time? Or
Yes, it would, because if you look, this 100 that's left over, the expectation is we're going to sell that 100 right in the next quarter. So we're not having 1,500 left over for the next quarter.
Yeah.
We're having just enough left over in the next quarter to get us started until our production for that quarter can ramp up and we'll produce them as fast as we're selling them.
Okay.
So even when you're talking just-in-time management, you still usually have to have some overlap. I've got to have a little bit left over this time to start next time, so that my production for next time, is tracking with it.
Yeah.
Okay?
Yep.
Very good question, though. Okay. So let's think back to, now we know how many we need to produce each quarter, right? So, and we're pretty much done with this exercise now, but now we know this budgeted part down here. We know how many we got to produce during each quarter. Well, if we know how many we've got to produce each quarter, then it's pretty easy to say, all right, well, how much material do I need to make? If I'm making 1,050 of them, let's just look at the first quarter of the year. If I'm making 1,050 of them, how much material do I need in order to make 1,050? How much labor is it going to take me to make 150? What is my overhead that's going to be involved in make that, that variable overhead that's going to be involved in? In this case, we're saying variable overhead times the direct labor gives us is our driver. That goes back to chapter 2 stuff. Okay, so now we're to that point. Remember on that chart that's on, go back and look at that chart on 300. So all of this back here, on this slide back here, was just doing that block that's called our budgeted inventory, our budgeted, our production budget, man. So now we're talking about those next 3 blocks, those green blocks down there. So so we determine the materials that we need based on our production, and we calculate the cost distribution, how much it's going to cost us to buy those materials. We're looking at our direct labor. How much labor is it going to cost us in order to pay our production folks? What's the cost of that? Our manufacturing overhead, our variable overhead rate. And remember, our variable overhead rate is how much do we expect our variable overhead to be times divided by times how much our labor hours is. Okay. Our budgeted fixed overhead. Remember, we've got fixed overhead we still have to account for. And then we have to figure all of that into, our cash disbursement. How much money are we going to actually have to lay out to cover all of these expenses? Because if you look at that chart, all those arrows go down into that cash flow budget. Okay. If you look on that chart on 300 too, it tells you a bunch of different exhibits. That's these boxes, these other charts that you see. So if you have a question about, well, what is the sales budget, you can go to 7-7. Or what is the direct labor budget, you can go to 7-10. And that's the budgets when it says exhibit, that's the exhibits inside the chapters. Okay? When we start talking about our homework and the problems that's on the homework, that's always the problems at the back of the book. I didn't want you guys to get those confused. Okay? Or the problems at the back of the chapter. Okay, so our finished good inventory budget, and that's where, remember on that one chart we were talking, we know we have to have a certain amount of stuff left over in order to start the next quarter with, right? Well, when we talk about how much the value of all of that is, what was the direct material budget and labor budget, manufacturing and overhead that went into that, okay? We figure out what it costs per unit. And then we say, well, we multiply that by how many units are we going to put into our finished goods inventory. That's how we calculate the value of what's in our finished goods inventory. We got to know how much our per unit cost is times how much did we put in inventory. Sales and administrative expenses, SG&A. Okay. They're saying administrative expenses. When you see SG&A, it's sales and general expenses. Sales, general, administrative expenses. They're leaving the word general out of here. It's all still the same thing, okay? Our sales salary, our rent. Now the sales salary is calculated here as opposed to in our production, because sales doesn't have anything to do with the actual production, does it? Sales is an expense, but it's external to our production process. That's why, looking at that chart on 300, it's out there on the right-hand side. It's part of our operating budget because we still have to pay those folks. They're part of what we do when we operate. But then we have an operational budget and then we have a financial budget. It's not part of our production. It's not part of our manufacturing, but it is part of our operations. And then obviously if we're paying them, it's part of our financial cost. But we got advertising and insurance and rent, a bunch of administrative expenses that have to be calculated into our financial budget. Okay, so now we're going to hit learning to do a financial budget. And you know what? It's about 10 till, so let's take a break so we see if we can get you guys to the front of the coffee line again. Yay! I still think you guys need to go over there and beat them up and tell them they need to be there at 7:30 so you can get coffee before your class.
Amen.
I tried to tell Zach that, but he didn't listen.
He didn't want to listen, huh?
No.
Did you tell him I said it?
Yeah, he still didn't listen.
All right. So let's take a break. You guys go get you some coffee and stuff. Try to be back by about 8:10 so we can get back into it, okay?
Okay.
All right. See you in a bit.
See you later.
8, 9, 10.
Hey, Owen.
How's it going?
I still owe you a couple of graded things, your quiz and your one of your assignments. I'll try to get those done this evening.
Oh, sure. Yeah, no problem.
Just taking a quick glance at it while we were on break, it looks pretty good. But I haven't actually sat down and done the grading on it. So,
Oh, okay, nice. I'm pretty sure that I got stuck in the line again.
so where'd you say you live?
Pleasant Hill.
That's right,
Yep, I'm a Pleasant Hill Billy.
a Pleasant Hillbilly, huh? That's where I lived before I moved to Texas. I haven't heard that phrase in a little while.
Yep. Go Roosters. Yeah.
And your shades of purple.
Right. Yeah, I played for the baseball team for like 4 or 5 years in high school. So that was
That's
fun.
cool. So are you a senior this year?
Yep, I'm a senior this year. I'm not playing this year. I'm focusing more on like school and work and stuff. So
Okay.
yeah.
So are you going to be out at Calvary full time this fall? This next fall, I should say.
Possibly, yeah. I'm still kind of, thinking about everything. Um, I've also been looking at Spurgeon College.
Where's Spurgeon?
It's up in North Kansas City.
Okay. I knew I'd heard the name before, but I couldn't remember where it was.
Yeah. Yeah, I'm just kind of figuring out everything right now, so.
What, you're at the age where that's what you're supposed to be doing.
Yep. It's pretty
I'm
intense,
I'm of an age where I'm supposed to already have it figured out yet, and I don't, so.
Yeah. I mean, it's kind of crazy, like, I'm only 17 and, like, trying to, shape my future, just as.
Oh, hey, no, trust me. Oh, the only thing you can do is make decisions on where you want to be in the next 4 or 5 years, or
Yeah.
make plans on where you want to be on the next 4 or 5 years, and make decisions based on that.
Yeah.
If you try to figure out where you want to be when you're 40, you'll go nuts. Okay?
Right.
So, yes, you've got long-term goals, but right now you're making plans based on short-term goals.
That's right, yeah.
My biggest thing, and this is what I ask the college students too, those that are seniors and fixing to graduate, is do you have a plan? When I was in the military and I had soldiers that had come in, they'd done their 4 years and they were getting out, I always tried to talk them into staying. But if they decided, no, I'm getting out, I'm determined, I'm not staying in the Army, I'm getting out, my next question to them is, do you have a plan?
Yeah.
If you don't have a plan, then getting out doesn't make sense. If you've got a plan, like, yes, as soon as I get out, I'm going to use my GI Bill, I'm going to go back to college, then great. Or yes, when I get out, I already know that I have a job lined up, I'm going to go, to here, and I'm going to, great. But if you don't have a plan, then what are you doing? Okay. Well, it's the same thing for you coming out of high school. Do you have a plan? So right now, that you've got this year to set that plan in motion. And oh, by the way, if you make a plan, and kind of going back to that decision-making wheel we talked about the first few minutes of class, if you make a plan and you're on that decision wheel and you have your controls in place and you realize, hey, wait a minute, this ain't working, don't be afraid to back up, reevaluate, and change the plan.
Yeah.
My life lesson for the day.
Awesome. Yeah, that's good advice. Yeah.
Okay, ladies, you guys ready? Sometimes I'm not sure they hear me.
Oh, you think you can take me back?
Okay, so let's keep moving. Wait a minute, we're missing one.
Yes, it does. Okay, I'll just erase it.
About one.
Okay, fine. You don't have to. Can I turn it on? No, it's on.
It is on.
Yeah, it's on.
I mean, we just got distracted by something.
Oh, trying to get
Got
around.
distracted, huh? See, if you put them phones down and turn them over so you can't see the front of them, you wouldn't get
Just try-
distracted by them.
She's trying to find a ride to the airport. She's leaving today.
Yeah, she's gotta go
You
home.
should have done that yesterday.
I
Well, she
did. My
did.
ride ditched me.
This
You
morning-
had one and it fell through, huh?
Yeah.
Yes.
Yeah,
In fact,
like-
my Coach Robbie. Yes. Him. Boy. I'm just kidding. Sorry, Coach.
Throw him under the bus.
You going to the? What are you going to the airport today for?
I'm going back home for my sister's wedding.
Ah. Well, I guess that's a pretty good reason to go back home.
Eh.
Are you in the wedding?
What's up?
Are you in?
Are you in the wedding, as in a bridesmaid?
Yes, I am.
Okay. I guess that's a pretty good reason to show up then.
Yeah, pretty good.
Okay, so let's get back into it. Now, so far we've talked about our sales budget and we've talked about our production budget. We've talked about our expense budget. Now we're going to get into that financial budget. Okay, our financial budget basically is made up of two things. Our cash budget, and that's cash that we're outlaying. And then what's our final budgeted balance sheet? Okay, that cash budget and that budgeted balance sheet, that's the stuff that in that little bracket thing, I don't even know what they call those things anymore, but that little bracket thingy on the bottom of that chart on 300, we're talking about our cash budget and our budgeted balance budget. So our cash budget, what things go into our cash budget? Cash collections, what are we collecting from our customers? Okay, how much are we paying out for what we're producing? How much are we paying out in our sales and administrative expenses? How much are we paying out in our capital expenditures? How much are we paying out in dividends? Now, dividends is listed there because it is a piece of the cash budget, but we don't, as far as the purposes of this class, we don't really deal with the dividends much, and we don't really deal with the finance and repayment on interest and notes. You guys have to know it's there because if you borrow money, you got to pay it back, and that's part of your cash budget. You got a budget for paying it back. Okay, we don't get into that a whole lot in this class. All right, so we're going to look on a budgeted on a cash flow budget sheet. All right. This chart has an error in it. Okay. And I will tell you, as we go along, if you guys find the error and point it out to me before I point it out to you, I will, I might make some point considerations. Let me put it that way. Okay. So as we're going along, if you guys catch the error, let me know. So we're talking about Q1 and Q2 for this business. Now, see, now I got them paying attention.
Wait, can you put your screen on the computer?
Oh, I'm sorry.
No, you're fine.
I forgot to put it back up there.
I should have just gone to
So let me back up half a second since I wasn't sharing those. So learning objective 4, we talked about it was cash budget. So then there's a chart here that shows those things we were talking about, cash collections, all of those different things that go into the cash budget. Okay, so now we're looking at this chart. And we're going to go down this and we're going to kind of pay attention to the things that are in here and how it comes into making up our cash budget. All right. So it says our beginning cash, and let's just say this is in the thousands. Okay. So this, instead of $20, it's $20,000. Okay. So just to take that into consideration, so $20,000. Okay, so we add cash that we collected from our customers, we added another $8,000. So our total cash available for this quarter is $28,000. So now we have to subtract the different things that cost us money, okay, or things that we have to outlay money for. So our direct materials is $3,000. Our direct labor, $9,000. Our manufacturing overhead we calculate to be $4,000. We've got $6,000 in sales and general administrative expenses. And then we purchased equipment for $5,000. And we're paying dividends. Remember I told you we're not going to really get into what the dividends are and how they're all calculated and all that, but so we're making money, so we're paying dividends of $1,000. So you all add all that up and you get $28,000. Okay? Well, if you got the $28,000 less the cash that you started with, you got a negative $8,000. Okay, you guys didn't catch it.
No, it equals 0 because the 8 shouldn't be added.
Say that again.
It equals 0 because 28 minus 28 is 0.
Right. Do you see the mistake they did when they were doing this chart, though? Because I pulled this chart from the book. Do you see the mistake they made?
Well, all those numbers add up to equal 28.
Okay.
You have 12 plus.
So our total cash disbursement's 28, but they got a negative 8 down here. How did they get a negative 8? Where did they make their mistake?
The 20, they took 20 minus.
Right.
28.
Instead of going to their cash available, they went up, and it's real easy to do when you're putting the chart like this together. They went up, instead of clicking this box, they clicked this box. Okay.
Yeah.
Now, after we get done talking with this, I'm going to show you how that makes a difference. Okay.
Okay.
So let's just say, for the purposes of continuing on with their chart, that they had done it correct and they had they were $8,000 negative in their cash. Well, in order to continue doing business as they got into the next quarter, they still got to have cash to do business, right?
Yeah.
So they went to the bank and they borrowed $13,000. Well, once they borrow the $13,000, they now have an influx of cash. So if they take the $13,000, subtract the $8,000 that they thought they had as a negative, now they got $5,000 in cash at the end of the quarter, right? And they're going to roll that $5,000 left at this quarter. They're going to roll it up and it becomes the beginning cash for the next quarter.
Oh my goodness.
And they go through the same exercise next time. Their numbers are a little different, okay? They got 45, their cash that they collected from their customers was $40,000. So they got $45,000 cash available. Direct materials was $2,000. Their direct labor was $7,000. Their manufacturing overhead was $4,000. Their sales and administrative costs was $6,000. They're still paying $1,000 out in dividends. You add that up, it's $20,000. Subtract the $25,000 from the $45,000 cash on hand. You got $25,000 net cash. Okay. Well, now we borrowed $13,000 last month, right? So in this case, what they're doing is they're saying, I want to pay that $13,000 back off. I don't want to have that on my books anymore. So they're going to pay back the $13,000. But money's not free, is it?
No.
When we borrow money, we got to pay interest on it, right? So on this $13,000, they have to pay $1,000 in interest. So in total, what they're paying back is $14,000 instead of $13,000. Gives them $11,000 left over this quarter that they would then roll over and start the third quarter with.
Wait, I have a question. So
Sure.
if this chart was correct, then it would be 0. So would they have to borrow money?
Well, no, they wouldn't have to, but let's look at it. So what I'm going to do is this is done up as an Excel spreadsheet. I'm going to put it back into an Excel form instead of a PowerPoint form. And I'm going to say, okay, they did their math wrong, okay, to get here. If you look, can you guys see this up here? I don't know, can you see the formula bar? Okay,
Looks blurry.
so they did B4 minus B14. So they did B4 minus B14. Okay, so I'm going to change that B4 to B6. So now this one on the left-hand side is going to be correct. And I'm going to hit enter. So now look what it did. So now we wouldn't have had to borrow any money. But the reality is we would have still had zero cash to start next month with. So they probably still would have wanted to borrow some money. They maybe just wouldn't have borrowed as much. As when on their chart, they borrowed 13,000 because they had a -8. That left them 5,000 to roll over to next month. So instead of borrowing 13,000, maybe they would have only borrowed 5,000 to roll over to next month.
Oh,
Okay?
that's a horrible mistake. Like if that's what their accountants actually did,
Yeah.
that
And-
hurts me inside.
And trust me, people make those kinds of mistakes all of the time.
That's crazy.
It's very easy to do to simply go up and click on a wrong box.
Wait, okay, so like,
I've even caught you guys doing it on your homework.
well, yeah. Yeah. So
Okay,
like
so
in a corporation,
if you look now, see at this point now when we change that one calculation, well now let's say they decided they were going to go ahead and borrow the 13,000 because they wanted to make more stuff, whatever. So they borrowed the 13,000, so the 13,000 now rolls up to here. They come back down here. Now they've got more cash available. They still got the same expenses at 20,000. So they've got more cash and they've got more net cash left over. They're going to pay that 13,000 back. So now they've got 19,000 that they're rolling over to the next quarter. Instead of the 11,000 that was in the slide.
that's so
Okay.
crazy. In a corporation, like, okay, so you probably have like your accounting manager and then like all of your accounting other people. And so do they always check through that?
Oh yeah, in a corporation, they've got accountants that are doing this. This is probably something that was done by an accountant, and then they're going to have accounting managers that are going to verify numbers, and then you have CPAs that come in and audit your books because most companies anyway every year they have a CPA. Now they may have an internal CPA, certified public accountant, that audits their books internally, but like Calvary every year, you guys know Miss Tasha up in administration,
Yeah.
Tasha Young. Tasha is the school's accountant for Calvary, and right now because the school year ended in July, in the months of August and September, she's always preparing all of the documents and everything. So that in October we have an external CPA that comes in and sits down and audits all the books for the school. And that's a requirement for the way Calvary's governed. It's a requirement every year that we have an external audit of our books, and that's big. And we have to do that because being a 501c3, which means we're a nonprofit.
Yeah.
501c3 is just the tax code that governs nonprofits. But because we're a nonprofit organization, we must do an external audit every year. So right now, that's exactly what Ms. Tasha is doing. Is she's going back and she's validating all the numbers that she did throughout the course of the year, and she's going to then turn all of that information over to a CPA who will come in and do checks and balances and make sure that all the work she did was correct. So yes, there's a number of checks that are built into the process.
That's good. That's a little scary.
Okay, so now let's go in our book to page 327, exercise 7-14. So we're going to work out a couple of exercises here, just so you guys get a flow for how this stuff works.
27. 327.
Okay, so exercise 7-14. It's a real simple one. It says, Agua Olé distributes bottled water. Okay, it says refer back to objective 4 in the book. So if you want to follow, if you wanted to, if this is not one of the homeworks, but if you wanted to, you could go back to objective 4 in the book to see how we're working this stuff out. Okay, so requirement 1 for each item, each of the items A through C, compute. Am I looking at the right one? Yeah, okay. Says for each item A through C, compute the cost of the cash, cash receipts or payments Agua will budget for September. Okay, the solution to one item may depend on the answer for an earlier item. All right, so let's look at A. Management expects to sell equipment that cost the company $22,000 at a gain of $4,000. There's an accumulated depreciation of the equipment for $7,000. So let's look at how we would put that on a spreadsheet. Okay, so the cost, what did it cost the company? It cost the company $22,000. That's what it said in here. Okay, they're gonna sell a piece of equipment that cost us $22,000. Okay. And they said they have an accumulated depreciation of $7,000. Now, again, we haven't gotten a lot into depreciation and how all of that works, but I'm going to kind of give you a real quick, down and dirty explanation. Let's say they bought this piece of equipment 7,000 years, or 7,000. Let's say they bought this piece of equipment 7 years ago. And in their depreciation process, they're depreciating $1,000 a year. So that would be $7,000. That's one way to do it. But it may have been that they bought this piece of equipment 1 year ago, and their intent was to depreciate it in 3 years. So in 1 year worth, they're going to depreciate it in 3 years. So they've got $7,000 this year and $7,000 next year. And in the third year, they're going to depreciate $8,000 too. And then what that depreciation does is basically it says, yes, I still have that piece of equipment, but now instead of it being worth $22,000, now it's worth $7,000 less. That's what depreciation means. You're depreciating, or you're lowering the value on your books of what a piece of equipment is worth. And we can only depreciate hard assets, like a machine or a truck, or those types of things. So again, going back to our story problem, it cost the company $22,000 when they bought it. They've had it for a period of time. We don't know, the book doesn't tell us, but over the course of that period of time, they've depreciated the value of it by $7,000. Well, if we take our cost minus our depreciation, that gives us our book value. How much is that piece on our books? How much is that piece of equipment worth now? Okay. But the story goes on to say they're going to sell it at $22,000 at a gain of $4,000. So if it's on our books at $15,000 and we're going to gain $4,000, that means they're actually selling it for $19,000. You guys follow how that math works?
Yes.
Okay. So you got to remember, when somebody tells you what the cost is minus the depreciation, that gives you the book value. Now, if they just said that they were selling it at a loss of $4,000, we'd have taken that 15 minus the 4,000, and then we'd have said, okay, we sold it at 11,000. So you just have to pay attention to the terms that they're using. Did they gain money or did they lose money? If they gained money, you take the gain that they had, add that to the book value, and that tells you how much they sold it for. Or what they may have done is they said, we're going to sell this for 19,000. It was 22,000 when we bought it. We have $7,000 in depreciation. Okay, what was our gain or loss? Well, you'd had to take the 22 minus the 17 to get the 15, and then if they told you they sold it for 19,000, once you know the book value, you can do the math and say, oh, okay, we gained $4,000. It's just a matter of what part you have to calculate for. In this case, we were calculating for how much did we actually sell it for. So let's move on to the next part of this. This is 7-14, continued. So we're going to look at B. Management expects to sell 7,800 cases of water in August, and they expect to sell 9,100 cases of water in September. Pretty easy, right? Just plug that in for August and September. Each case of water sells for $13. So they plug that in. So our expected sales, our total sales, is $101,400 for August and $118,300 for September. Pretty straightforward, right? Just that how many cases are we selling times what we're selling it for to get our sales. But now we're going to get into the next piece of this financial budgeting, and that is sometimes our customers pay us in cash, sometimes they pay us in credit, and sometimes they pay us in a combination. Okay? We don't know if we sold all of these cases to one person or if we sold them to a bunch of folks. But the bottom line is, of this, it says 30% of it was cash sales and 70% of it was credit sales. So if you do the math, if you take the 101,400 times 0.3, which is 30%, you're going to get $30,042. If you take the same $101,400 times 0.7, which is the 70%, you're going to get the $7,980. Again, pretty straightforward, right? It's this number times 0.3 or 0.7. Same thing for September times 0.3 and 0.7. Now here's where it starts to get interesting. Because what we're actually doing is we're calculating how much cash is going to come in for September. Okay? Well, let's calculate how much cash is going to come in for October. Or excuse me, let's calculate how much cash is coming in for August. Well, they don't give us enough information to do that. So we're going to look at September's sales. So September's credit sales. So our cash sale, this is how much we got in cash in September, right? Let's go back and read some more in the story problem. So where we're picking up in our story problem, it says cash sales is 30% of sales, credit sales is 70% of sales, but then the next sentence is very critical. 3/4 of the credit sales is collected in the month of the sale, with the balance being collected in the following month. So we know this much is our cash sales right here for September. Okay. We know that we collect 3/4 of our credit sales in the month that it was sold. So if we take the 82,810, we're going to collect 3/4 of that, or 75%, in the month that we sold it. We just didn't collect it as it was going out the door, but within that 30 days, we're going to collect 3/4 of that money. So in September, we have to take this number times 0.75. So we're going to collect 75% of this in that same month. All right? But in August, we collected this much of our credit sales. But the book tells us the following month we collect the rest. So what we have to do is take this 70,980 times 0.25, because what we didn't collect in August, we're going to collect in September. You guys following with how this is working?
Yes.
Okay, so our cash sales plus our credit sales at 75% for the month that it was sold, plus the 25% that was left over from the previous month. And if we add all of that up, what do we get for our cash collection for the month of September?
Is it the
Somebody
60?
do the math for me.
I don't have my calculator.
You got it, Owen?
Yeah, I'm working on it.
Don't they have it right there?
Don't they have it right where?
Isn't it the 62,108?
No, the 62,108 is the 75% of our credit sales in September.
Oh,
But
so I
remember, we also had, we're calculating our cash collections in September. So in September, we had our cash sales. We had the 62,108 that we collected in September for our credit sales in September. But remember, we had some credit sales in August that we didn't collect in August. So we have to look at the August credit sales times 25%. This is this number right here.
yeah.
Gives us this. So we're collecting money in September for stuff we sold in August. So if you add these three together, that's going to give you your total September cash collection.
Okay. So it's $115,343.
There you go. Does that make sense? Do you guys see how we got that number?
Yeah, I just really overthought it, and
Okay.
Yeah.
So let's continue on. Okay. So 7-14, the company pays rent and property taxes of $4,000 per month, commission and other sales expenses of 25% of the sales. Agua pays 2/3 of the commissions in the month they occurred, with a balance being paid the following month. So this is the same process we just did, only it's 2/3 instead of 75%. Okay? So 25% of the sales, we know that the sales, we got to back up here. The sales for August was $7,850. If $7,850 times 0.25 should come to, or excuse me, $101,400 is our sales. I was back up to units sold. See how easy it is to go to the wrong box?
yeah.
Okay, so our cash sales for September is $101,400 times 25% gives us $25,350.
Yeah.
You guys get that?
Yep.
Okay, so this is our cash sales. All right, so they tell us that our rent and property taxes is $4,000 a month. We got to add that in. In September, now if you look, this is me spelling it all the way out. It's the 9,000 in September. 9,100 units times the 13 is 118. You can do it this way. This is laying it all out. Or you could just simply say 118,300, because you'd already done that math back here. Okay.
Yeah.
times 25%. Okay, that's this number. So the 575 times 2/3. Now, do you guys know how to make 2/3 into a decimal?
Yeah, it's like 0.3.
Well, if you're
666.
1/3
Oh yeah,
would be
that's 1/3.
1/3 would be 0.333.
Yeah.
Okay, so
So
2/3 is going to be 0.666, and I know none of us like using 666, but sometimes you have to. Okay. Okay, so you're going to have the 29,575 times 0.666 to get $19,717. Okay, but remember, in the book it told us that they collect 2/3 in the month that occurred and the balance in the next month. So to find out how much cash we're paying out, we have to go back and say, okay, well, we're paying this cash out, we're paying this out, but oh yeah, I still owe my sales guys money for the month of September, or excuse me, October, August. Man, I'll get this straight one of these days.
it's all right.
August, September. So we know we had 25,350. If you do the 7,800 times the 13 times 0.25, that gives you this number.
Yeah.
So if we take the 25,350 times 0.333, we're going to get the 8,450. And then we're just going to add these three together, and that's our cash layout for September.
32,167.
There you go. You guys follow how we got through these three slides, because this is the same basic type stuff you're going to be doing in some of your homework.
Basically, just follow the charts.
Well, just follow the examples here in the charts. Yes. Okay. Now you're going to be doing other stuff in the homework, but this is definitely one. I think it's two of the problems in the homework.
Okay.
Okay. So learning objective 5, sensitivity analysis in budgeting. Okay. Sensitivity analysis is going back to the same thing we did when we did sensitivity analysis when we were doing our break-even points. Okay, what happens if we change one of the variables or one of the calculations or one of the numbers in our calculation? Okay.
Well, it throws off the whole thing. We saw that.
It doesn't throw it off, it makes us adjust.
Yeah,
There's a
it
difference in
just.
terminology.
Okay, sorry.
So we've budgeted, okay? Our actual results often differ from our budgeted amounts. And that's where our sensitivity comes in. We have to go in and look at how do our actuals compare to our budget?
Our
Okay.
budget is basically just like overall, almost broad. Like we're trying to encapsulate all the extra expenses and the regular expenses to show where our money's going. But then the actual results show exactly what we put our money to.
Right. Budget is what we expect to happen.
Yeah.
Actual is what did happen. So if you go back to the company that was selling the rims when we were doing that exercise, in that fourth quarter they expected to sell $200,000 in rims. They may have sold $200,000 in rims, but they may have only sold $180,000 in rims. Or they may have sold $210,000 in rims. So they may have sold more or less than they expected to. Okay, so let's look at it. If we sell more than we expect, what's that going to do to our budgets?
Gonna make us have more money for the next month. Potentially.
If we sell more than we expect, yes, there's going to be additional money, but there's also going to be additional expenses.
Yeah.
Because, if we're selling a Subway sandwich for a certain amount of money, and now all of a sudden we sell more Subway sandwiches than we expected, We got more expenses in bread and cheese and lettuce and all of that other stuff, right? So our variable costs are going to go up, but our sales are going to go up too, so it should cover our variable costs. The nice thing about it is when we exceed our budget, we have a set budget that we expect to happen. When we exceed it, most of the time that's a good thing. Not always, because sometimes when you're using the just-in-time inventory process, if you exceed your process, you may actually run out of supplies.
Yeah,
So
especially.
that's why budgeting is so critical. And the first part of the budget, and why it is ultimately the most important calculation in the whole process, is how and what is our sales. Okay. The reality is Calvary has a sales budget too. You guys have any clue what our sales budget is? What item what item are we selling at Calvary?
Tuition or education.
Well, education is the process. You had it right the first time. Tuition. How much money are the students paying per credit hour for tuition? Because that tuition money is what pays all of our bills.
Yeah.
Now, that tuition money comes in a lot of ways. Sometimes you guys are just paying it outright cash. Sometimes you're getting financial assistance where you got the government grants. Sometimes you're taking out student loans. But as far as Calvary is concerned, it's how many credit hours are we selling that's bringing money in to pay our bills. So if we, let's say we targeted it for this fall semester, we were going to sell 5,000 credit hours. Well, if we sell 6,000 credit hours, we've exceeded our budget. We don't have a whole lot of additional expenses, so we're actually making a little extra money, which is a good thing because usually we've got other bills that need to be paid. But if we're selling 5,000, or we expect to sell 5,000 credit hours, and we only sell 4,400 credit hours, well, then now we're 600 credit hours short. And if we've budgeted on 5,000, then we may not have enough money coming in to pay all of our bills. So that's why understanding this budget sensitivity is critical. We have to make sure we understand what happens if we over budget or if we under budget. So let's look at let's look at the roll-up process. All right. And again, I'm going to kind of look at Calvary when I look at this model. In this model, we have a Department A and a Department B. All right. In this model, I'm going to say Department A is the undergraduate or the college, and Department B is the seminary. You guys tracking with me? So our undergraduate department has a bunch of other smaller departments. Okay. We've got the business department and the music department and all of these other departments that fall up under Department A. In Department B, we really only have one department, and that is, the graduate program and the expenses that go along with it. We could break that down and say, well, we've got the seminary and we've got the graduate school, but the reality is they roll up kind of as one. So in this case, we're going to take multiple smaller budgets that roll up to a bigger department budget, and then those two department budgets roll up into the company budget worldwide. So it's just a matter of taking smaller segments and figuring out the budget for each smaller segment, rolling it up to the higher department, which then rolls up to the entire institution. Pretty common sense, right? This kind of says the same thing we just talked about. All right, so that gets us to the end of chapter 7. All right, what I want to do at this point is I'm going to stop sharing for a minute. And I believe if I did this right, okay, do you guys see the homework for chapter 7 up on the screen?
Yeah, it's just blurry. I'll log into the Teams meeting.
All right. So log in and take a look at it. Okay. If you look at 7-2, I've given you a couple of answers in there. You have to plug the rest of them in. 7-3, what couple of things I wanted to point out to you on 7-3. It talks about the cost of shoes, okay? But here it talks about this is $165 for the cost of shoes here, and it's $220 for the cost of shoes here. So when you guys go to plug those numbers in down here, okay, the sales price for the shoes in January, sales price in February, don't add those across because the sales price for the shoes didn't say the same, it changed. So in this one, do not add these across. This total down here is going to come from the net sales, because once you do the right math up here and you get your net sales, you can add that across to get the total. Okay? And then for this one, you just got to transfer the right information from this chart based on what the story problem tells you down into this chart. Some of it you're going to transfer the exact same information. Some of it you're going to change based on the story problem.
Okay.
Here's where this is the main part I wanted to talk to you about. Okay. So this is our production budget. You're going to figure out a production budget for this company. Okay. Now, mind you, it says, the information for the sales budget prepared in 7-3. So you got to come back up here to 7-3 and you're going to get information from here that's going to come down into here. Okay? But we're going to do a production budget. Now, once you've done the production budget, information from here, you notice this has got, you get 40 extra bonus points this week. You don't have to do the bonus work, but if you want some extra points to maybe make up where you were missing some stuff from other other homework assignments, this is the point at which you do it. Okay? So information from this production budget is going to come down here. Because you see it says budgeted production. So you get your information up here, you're going to transfer it down into this chart. So once you know how much you got to produce, then how much is our direct materials going to cost us? How much is our direct labor going to cost us? And what's our manufacturing overhead budget? Okay. Another note, and I've already given you down here, okay, pair of shoes. A cost per shoe, because if you read the story problem up here, it gives you the cost of a shoe. So it's $20 in variable manufacturing cost per shoe. But this chart down here talks about pairs of shoes. Okay, so you got to keep that in mind. One shoe times 2 shoes per pair. At least most of us use 2 shoes per pair. So you got to get $40 a pair. All right? You guys have any questions moving forward?
Is it due in 2 weeks or is that due next week?
Okay, so yes, that is a good question. This homework is actually due in 2 weeks. The reason this homework is due in 2 weeks is because kind of unlike what I did in week 3, where I had you guys do a quiz and a homework in the same week, what I did was I spread it out a little bit. This week, what you've got to do is the quiz for chapters 5 and 6. Okay? Now, my suggestion to you is don't wait 2 weeks to do this homework. After you get that quiz done, go ahead and do this homework. Okay? Because we're still going to have class next week. But after we have class next week, if you're trying to do this homework, then you may have forgotten some of the stuff that we've talked about for this homework. So my suggestion to you is go ahead and get that quiz done fairly early, and then get this homework done, and then you can kind of take a break for a few days. Make sense? But you guys work that out. You guys have time management. One of the reasons I do this instead of making you do the quiz and the homework on the same week is because I know we're getting to a point where in your other classes you got a bunch of homework and papers to write and a bunch of things you got to get done. So I'm trying to cut you a little bit of slack there, okay? So, any other questions? If not, you guys have a good week. And if you guys need me, send me an email through the week and we can communicate. But other than that, I will see you guys next Thursday.
See you next Thursday.
Yes, thank you.
Thank you.
Awesome. Thank
Yep.
you so much.
Have a good day.
Bye.